Around the overall debt portfolio, just have a couple points on page one. The first is right now the county has approximately $362 million of total outstanding debt service to be paid over quite a few years, and that is both principal and interest. So of that number, that's comprised of 19 different bond issues or note issues or various loans. The total principal amount of that debt is about $254 million. And the interest and some of the fees, you heard your auditor mention that some of the fees about $107 million. Some of those fees include the standby purchase agreement fee and the remarketing fee and S&P Standard & Poor's surveillance fee that are related to the 2006A bonds. You're here, the 2006A bonds are going to be a very common theme regarding some issues with your debt portfolio that need to be addressed, that we've sort of been putting some Band-Aids on over the past couple of years. And we feel now, starting in 2015, we definitely need to do some kind of more of a permanent solution with that. And again, we mentioned there at the bottom, the liquidity facility fee on the 2006A bonds has just been extended to April of 2015. Since the spring of 2013, we've done 6 different extensions. We'll get a little bit more into detail on this, but the 2006A bonds, they're a variable rate debt instrument. A lot of your debt outstanding, you'll see from one of the next slides, a lot of your debt is traditional fixed rate debt, but you do have some non-traditional debt. When you have variable rate debt, not just Luzerne County, but any issuer out there, one of the very key components of that principal and interest that you also have to pay is this liquidity facility fee that the investors demand for them to buy these weekly rate bonds. Well, the county had a very good contract, if you will, with JP Morgan and PNC for basically from 2006 all the way through 2013. A very low fee, very market rate competitive fee. That expired in the spring of 2013. You probably remember me talking about it the past few years about that needed to be extended. Well, that fee is really predicated upon the county's underlying creditworthiness and kind of the market we're in right now. And that has increased a tremendous amount over the past couple of years, which I think one of the questions was asked to your auditor about some of that. This is all going to dovetail together. So we're going to talk more about it, but these 2006A bonds are a major issue and something that, again, I think we now finally need to put a permanent solution on the books for.
Excuse me, before you leave that slide, you have an interest and fees line there of $107 million. And those interest and fees are based on the current conditions. So as we get any increases in the fees and interest, obviously that number will grow.
That's right. Yeah.
So
I mean, even just to put it in perspective, very round numbers, so don't quote me on this. I would say that letter of credit fee or that standby liquidity facility fee in 2011 and 2012 was probably somewhere between $220,000 and $250,000 per year. That's now north of $2 million per year.
So repeat those numbers again one time so everybody understands.
Say in 2010, 2011, 2012,
yeah.
The county paid on an annual basis about $225,000, $250,000 per year for that fee, which again was a very, very good fee.
Right.
That number now is more than $2 million per year.
And that's for current, or is that for 2015?
That's current, and it's going to be a little bit higher for 2015.
So it's going to be well over $2 million in 2015.
Yeah.
So you're talking about $1.75 million difference, probably.
It's a huge difference. Yes.
In a matter of a year or two.
And we'll get.
Just a quick question for Scott on that issue. So when the county gets a AAA rating from Moody's, that'll go back down to $200,000, right?
Well, hopefully we'll have something in place so that we might even just get rid of this whole thing.
Well,
but yeah, if the county were able to get a very high investment grade credit rating, that would go down. That would go back down to that kind
to
of
the $200,000.
Yes.
Okay.
Thank you.
Let's be brief. The county's not here to mulch loan. Why are the banks gouging the hell out of us? Why are the banks gouging us? And what can be done about it?
Well, we'll show you some options that we can do about that. The fees that the county's experienced with this, you're right, I mean, the likelihood of the county defaulting, extremely minimal. But we're in a completely different financial market from 2000, prior to 2008, post 2008 from the market collapse. Prior to 2008, there was very little emphasis in the industry on the underlying credit of the issuers. It was basically, if you purchase bond insurance, if the county or the issuer purchased bond insurance, or if your letter of credit bank was with a very strong bank, they didn't even look to the underlying issuer. Whether it was Luzerne County, Detroit, state of Pennsylvania, whatever, they could care less as long as they had that bond insurance or a strong bank letter of credit. Now they look very closely to the underlying credit of the issuer and pretty much ignore the bank's credits, which is JP Morgan and PNC with this, and bond insurance companies. And they get very uneasy when they're seeing consistent deficits. And again, the likelihood of a default is pretty slim, but there's a very big premium now for, in the investor's eyes, kind of distressed credits. And that's why you see these fees go up tremendously.
Well, let's just put it right out there that maybe we wouldn't be struggling so much if they would be a little bit more reasonable with their fees. I mean, if somebody goes into distressed status as an individual, there's some negotiation with the creditors to try to reduce the fees so that they can survive and live to fight another day and maybe eventually have another line of credit that would be able to work for them. This is, the debt service that we're paying, and these fees are part of what's putting us in such financial difficulty.
Yeah, I mean, it really is a kind of a circular reference. I mean, there's also, there's arguments that the county should have never entered into this agreement back in 2006 because of the financial situation of the county. And for issuers that have kind of surplus funds, fund balances, kind of a rainy day fund, can weather some of the storms when the rates are not performing as expected. But unfortunately, that's where a lot of issuers across the state, across the country got into financial trouble related to interest rate swaps, related to non-traditional financings. I mean,
But they are part of what's causing our financial problems.
Oh, they understand that.
Right.
Absolutely. I mean, it's been driven home very clear.
Aren't some jurisdictions litigating this with the credit default swaps, with the LIBOR rate fixing, and some of these other issues? I think in the West there are some jurisdictions that have gone to court, taking the issuers to court. Are you familiar with any of that?
Yeah, I mean, there are some. As far as any of those succeeding, I'm not aware of anything succeeding at this point in time. But I suppose that also is an option.
Some of these fees that are really, as Mr. Orban said, gouging us, are with PNC Bank, right? Didn't we just enter into an agreement last year with PNC Bank to house all of the county, or most of the county money?
Yeah.
And what is that worth to PNC Bank? Is there any leverage for us with that?
There is some leverage, and we've
I
been
mean, we
discussing.
have $118 million of revenue that we house, probably most of it with PNC Bank throughout the course of the year, right?
Oh yeah, those relationships have been conveyed. They know. They
Do you
understand.
negotiate that kind of stuff on our behalf? Is that what you do, or do you just watch our debt and
No, when it comes to
report on it?
renegotiating these, absolutely, we're part of that.
Okay.
Absolutely. Yes.
Okay.
Just really briefly, isn't any negotiation based on how many suitors actually want to dance with you in the end?
That's a big part of it.
Could PNC not charge this because we don't have many other people who want to party with us? in the
Not a
end?
lot of other
No,
options.
but we have other
No, but I want to
banks.
be clear. I don't blame Wall Street. I really want to be clear here. I know a lot of people say, and it's easy to yell at Wall Street for these gouging, but why can they do it? The answer is easy. Because they can, and nobody else wants to dance with us, because for over decades we never took financial responsibility with ourselves. So I don't blame them for doing what they do. They're a business, and we know them, and if we want to yell at this mindless corporation, that's fine. It's not going to get us anywhere. But to be clear, you can negotiate only as good as there is somebody else who wants to be with us. And if I recall, PNC was one of, frankly, the only people who actually showed up to want to be dancing with us.
That's right.
So they get a fee fee for that. Is that fair to say?
That's right.
So I just really want to be clear. We can yell about them all we want, and they gouge us, and that's perfectly fine. But this was the highest year ever for municipal tax bonds. We ever saw the returns this particular year. People are investing in Puerto Rican bonds now, for goodness sakes, even if they don't. There are people out there who will take this, but what we are not a suitable dance partner. So we can keep yelling about Wall Street, or we can say, you know what? We have to realize they are where it's at. They're not going anywhere, and we have to just do whatever we can to get better in their eyes. It's that simple. So I don't really care if we want to yell about it. It's not going to do you any good.
I think that's fair. I mean, there's not a lot of suitors out there, knocking on the doors of the county to extend credit or loan money. I mean, I think we've seen this over the years with the tax anticipation notes. That's always been an issue, trying to get cash flow money for, your first payrolls in January. Again, every year it's kind of an issue. We have an RFP out on the street that we put out this week or last week. Again, to try to get a tax anticipation note for the county, so you have it come January 2. There's not a lot of banks lining up to want to extend that. So there is limited negotiating power, if you will, when you're a creditworthy kind of this nature. When you're creditworthiness of a higher rated entity, double A or triple A or even single A, you have more options. But unfortunately, the county does not have a lot of options. But you will see on one of the last pages, we do have some options to deal with this. Someone will come at a cost, but it will give you also more certainty.
Scott, you said something about, they said we needed some reserve funds.
Can't hear you, Steve.
You said that they needed some reserve funds.
No, an issuer that does have reserve funds kind of on the side, surplus funds, general fund balances,
Well, there was surplus
sometimes can
funds.
weather the storms better when you're seeing fluctuation in these kind of, whether it's interest rate swaps, whether it's variable rates. That doesn't necessarily put a sting on the budget. You're able to kind of subsidize from some of your rainy day funds in some of these bad times as well.
There are some surplus bond funds, correct? Some of the bond money that was allocated to projects was taken off the table in the reserve fund. Now I don't know if you know that or not.
Oh, yeah, from 2008, correct.
Right.
That's right.
And then also, isn't there additional money from this bond? Recently, when we passed the capital budget project, a lot of the money that was put into projects was taken out of those projects and it's sitting in a reserve fund to be used in the future.
Well, I don't think it's sitting in a reserve. I think it's just sitting in a capital fund to be spent on projects. I think most of it already been allocated for it, but I believe so. And I'm not sure what that number is. It's still about 10 million or somewhere in that ballpark.
It was 16 million that could be allocated. I believe we allocated somewhere around 6. I can tell you that this week there was payments to CEO and some other items on there that was probably in the ballpark of $900,000. So we don't run checks every week, but when we do run checks, they're usually bigger dollar amounts, and they are projects that are scheduled in the capital bond fund and get paid out of the capital bond fund.
So there's 10.
Yeah, but that money can only be used for capital projects. It can't be used for your operating fund at all. So the county cannot touch that reserve fund that was set aside in 2008. That money was set aside. The insurance company would only basically give an insurance commitment, and that bond issue could have only been done if that money was set aside. That money could be released in the future if the creditworthiness of the county did improve. So you do have that reserve, but you can't tap it. You also have unspent bond proceeds from 2008, but again, you can't tap into that for operating purposes. That can only be for capital projects.
I just want to correct one thing too. For most of my time when I was a commissioner, I didn't get involved in any of the bond financing or any of that stuff. But Ray Lowry from PNC Bank was always knocking on the door, wanting to lend the county money. And for the most part, the county used PNC Bank exclusively, except M&T, I think, was used once. So, PNC, in my opinion, is part of the problem. The county's always gone to them and used them, or they came to us wanting to lend money. And so PNC needs to look at themselves, and I disagree with what Mr. Bobak said about these fees, and they need to start looking at ways to work better with the county to lower the fees.
Well, I think we did hear that PNC has declined to participate in the tax anticipation note for the upcoming year. So there are some other banks that we're talking to that should have some interest, but we won't know that for a little bit. I mean, I guess we have some other slides, but just also to recap, I mean, I think it's also important to note that the county has not done a debt issuance since 2009. I mean, I think so I mean, that is a good thing. That at least we've not, when we first got involved, I guess it was probably the latter part of 2008 when we got involved. And there were obviously some structural deficits going on at the time with the county's budget. There's a kind of a large gap between the revenues and expenses. We then came in and said, okay, we have a couple more bites at the apple to do some debt restructurings, meaning you basically carve out some of your debt that you owe in the current year, the next year, and push it out later. Basically said you can do that in 2008, and you can do that in 2009, a small amount. After that, you're done. We recommended a debt policy for the county to entertain, basically stop doing a lot of that stuff, and from that point on, it has not occurred. So, I mean, that is one good thing. I think everyone kind of realized there were some issues going on prior to 2008. It was more or less addressed. Debt policy was implemented. We have not, even though you've seen these structural deficits, and you knew some structural deficits were coming, that was always one thing to easily kind of tap into and say, hey, let's kind of go more into debt and restructure some of it, push it out. It's going to cost the county more in the long run. The county has not done that. We have not recommended doing that. The county has not pursued it, which is great. But we haven't kind of added to some of the prior burden.
A very quick P&C question. So P&C has not expressed an interest in participating in the TAN. P&C has been an interesting dance partner with respect to the credit default swap. Should we take that personally, so to speak, or has P&C got a larger strategy of extricating itself from municipal credit markets?
Yeah, I mean, honestly, we can't really speak what's going behind
But
the
as
scenes.
an observer of the industry.
I think it's a bunch of different things. I mean, I think the banks, whether it's PNC or any bank, has a certain amount of credit exposure to a particular issue. They may be getting close or at their max of how much Luzerne County exposure they can have. So that is an issue. I think that's kind of a big part of it. There are some, again, whether it's PNC or other banks, we're seeing across the industry many banks shying away from distressed credits. The banking community, they have their higher ups to report to and make sure they're not taking losses or potential risk of default. And so we are seeing a lot of banks not really wanting to loan money to lower credit entities. I'm not saying all banks, but it's definitely, since the market crash, we've seen a lot more of that tone.
Scott, before you get into some of the things we can do and where we're going, I mean, when you take a step back, and I think we all know this, but it's important for the public to see that, you know, we're talking budget, we've just got information with the audit, and this is a huge task that fell upon us. I mean, what Mr. McGinley just mentioned before, a few years ago, you know, we're paying so much in fees and now how much, and that's something that we can't, there's not much we can do right now. I think that's the moral of the topic here, although hopefully we can have some options. And although we have other issues with our budget, this is a big hole, and it's a big challenge to continue to cut or find other revenue to come up with this. So, I mean, you know, I'm just saying that because it is one of these things that I think the public needs to understand, one of the challenges that we're all facing here. But I'm curious to see where we're going, how fast, how long is it going to take for us to be able to go back to movies because we've been hearing it's going to take a couple of years, but there's no one gives us a certain time frame. And I find that to be odd, because I do think we are taking a lot of the steps. I do think that there's a lot of positive things we're doing, like you just mentioned. But I'd have to believe that there should be some type of a time frame where we can at least go back and try to get
There are definitely some positive steps that have occurred. You know, I would say the one issue that is kind of hurting us or delaying us is the kind of the financial outcome. When you look at 2011, 2012, 2013, we haven't seen the numbers I think that the rating agencies are going to want to see. I mean, there's still deficits out there, and that's going to be an issue. I mean, we have great kind of qualitative, a great qualitative story to tell about the changes that have been made and different initiatives undertaking, but at the end of the day, it's still going to come down Here's a slide on page 7, we'll just skip around a little bit. This is a slide that's not going to bode well for us when we go to the rating agency. Kind of, if you just look at the bottom chart, where kind of on the left-hand side, ending general fund balance, 2010, about 7.8 million, 11 down to 3 million, 2012, negative 3.7 million, and I think the number I saw here for 13 is going to be even more negative. So it's going in the wrong direction.
But wasn't the 2010 and those few preceding years, wasn't that the result of a debt restructuring?
Yes, yeah, the 2010.
That's why we had a
because-
positive, that's why we had a
Well,
positive
that's right.
fund balance in
And
those
that
years.
was fully acknowledged when we tried to go to the rating agency back a few years ago. I mean, that was clearly relayed to them. And they
Right, and the 2010 audit that was completed on time was also a qualified audit, right?
That wasn't qualified.
It was not an unqualified audit,
That's
which
right.
is what our goal is at this point.
That's right.
Okay.
You're going to see more of that. Well, one of the things that have,
But if I could just stop right there, I mean, what you're saying, the trend is, what you're showing here, when you see the trend, that trend is a little bit misleading based off of what you just pointed out.
well,
Yes or no?
it's when you make the case to the rating, I mean, this is just one little excerpt here. When you make the case to the rating agency, it's a 40 or 50-page book that kind of shows all that back. There's a lot that goes into it. They're going to drill down into all the minute detail and all the minutia. That they're going to say, okay, well, why was there a surplus for the 2010 audit? And that actually, for the 2010 audit, there was not a restructuring.
No, the
done.
restructuring was the year before.
There was an 2008, 2009.
Which resulted in
A surplus
still,
in the prior years.
there was still a surplus.
Right, which then carried over.
That carried over, right.
There was not a restructuring done in 2010.
That wasn't because expenses were so much lower in 2010, it was
Right.
because there was still a carryover
There was
from
a
the debt
carryover, that's right,
restructuring.
yeah. And like I said, I mean, that is the case.
And I understand, if you're saying you're gonna give them a 40 or 50-page booklet, but today, for the people that you have here, you gave us a little snapshot, and you left out some pretty salient details
Right.
to that. You know, one being the unqualified status of the 2010 audit, and one being the reason for that positive general fund balance, which looks terrific if you only look at 2010. But if you go back and look at the history from 26 to 2010, leading up to that, it might not look quite as good as it does in this little snapshot.
Yeah, this slide, the intent more of this slide was, it kind of dovetails into why we are where we are with the 2006 A bonds. Kind of the story that when that letter of credit, or that standby liquidity facility initially came up for renewal in May of 2013, when we were talking to the banks about, okay, we got this renewal, they're looking at the financials as well. So not just the credit rating agencies, but also the banks that we're dealing with, JP Morgan, PNC. They're looking at the audits. Whether or not, for the bank's purposes, whether it's qualified or unqualified, I don't think it's as important to them as it is to the rating agencies. It's still a factor, still a criteria, but I'm not sure.
I think that was one of the things that you pointed out, though, if not this year, or last year, it was the year before, that we needed an unqualified audit.
Absolutely.
On time and unqualified.
Yeah, I think you're going
but-
to see it again in this
So
presentation.
now you're getting qualified, and hopefully next year it'll be on time.
Yes.
Right.
Yeah, we want an unqualified on-time audit. I mean, that's
Right.
what's going to make the rating agencies
Right.
the happiest, absolutely. But I think with again, the purpose of this slide is the reason we had to do to date about 6 extensions on this liquidity facility, and fees have gone up. We've been doing these short-term extensions. We've been doing these short-term extensions at zero cost to the county. We've been putting a lot of time into this over the past couple of years, haven't charged a dime for the work put into this, where the discussions with the banks have been, the tone has been more, well, let's see how the next year looks like. Let's wait for the next budget. Let's wait for the next audit and see how things progress. We hear that things are getting better. Finances should look good. The next audit should look good. And that's just where we haven't really seen it. I mean, yeah, there's been some positive trend. We haven't seen major go the wrong way, but we are still seeing deficits. At the end of the day, that's what the bank's getting to. So I agree. I mean, I don't want to mislead anybody or paint the wrong picture. Again, this was more for why the letter of credit fee had basically gone from 250,000 to over 2 million. It's, let's wait for the next year, let's wait for the next audit. The audit should be done, say, September of 2012. Well, we don't have it then, we don't have it until April of 2013, so we got to keep extending. Same with the following year. So again, this is no means trying to mislead anybody or paint the wrong picture. It's why why that fee has gone up, basically more than tenfold over the past couple of years. Maybe, why don't we just kind of skip to, let's see, why don't we skip to page 8? So again, the overall debt, well actually, I'm sorry, let's go back to, just to put it in perspective. Let's go back to page 2, the annual debt service page. I think the point was made, earlier, the debt service for the county, it's a big chunk of your general fund. We're looking at, almost 30 million of your general fund is related to debt service.
And I want to apologize, but you talk about the general fund and the debt service, Scott. Now, one of our issues was put out in order to finance an early retirement for the county's retirement system. Is that correct? The funds for that were used to help keep the funded balance up.
Yeah, I want to say that was back in 2002.
Okay, and how long a note is that? That's still active?
That goes out until 2017.
Okay, and we're paying all of that from the general fund, is that correct?
That one, yeah, correct, yeah.
Now, would it not be normal for us to allocate a portion of that cost to departments which contributed employees to that early retirement incentive and put some of the cost into our claiming rather than bite it all in the general fund?
I think that would be fair.
Okay, so that's something that we'll be working on during the year that hasn't been done before. We'll also see if we can claim retroactively for some of those. So, and probably will instead in next year, the cost will appear in the personnel side of things. And that's something that we would like your help with.
Sure.
Of setting up.
Yep.
And we would ask if there are any other areas in the bond, in the debt service portfolio that we are paying entirely out of general fund. If there are places where those payments should be reallocated, let's do that.
Absolutely. So this just gives you an idea of the magnitude of the kind of annual debt service. We talked on the first page about the total debt service over the life, 300 some odd million, and the principal and interest. This just shows you what the county is basically paying on an annual basis. Then, again, I think the theme here is the 2006A bonds. And if we go to page 8.
One thing I want to bring up. The next briefing is going to be about possibly giving away county land. That out of one of these bond issues, $4.1 million of bond money was used by land to protect the watershed in this county. And to me, to turn around and just give that away to the state for nothing, when we're paying $4.1 million back in principal plus the interest, is ludicrous.
Yeah, I just don't remember off the top of my head which bond
I think
issue.
it was the 203 issue.
I'm sorry, which one was 3?
203.
What's a $10 million bond? 10.6.
Yeah, that's, the 03C. Well, that one did some refunding of some 95, 97. We can double check that.
Yeah, it was for roof project and my man included in all 4.1 was spent to purchase the data.
4.1 was spent on the purchase of the land. Okay, we'll check into that. So on page 8, again, the 2006A, again, this is about $88 million bond issue. This is the variable rate one. The one issue that we're dealing with, the first point, is with the county lacking a credit rating. That's making some of our options a little bit tougher. With not a lot of banks or financial institutions knocking at the door, that makes things a little tougher. However, the one thing we do have going for us at the moment, whether or not it stays to be determined, is we are in a very low interest rate environment in general. Absolute rate levels, are very low, no matter what credit you are, whether you're the highest, best credit, or whether you're the lowest, worst credit. We're in a very low rate environment. So some of the preliminary analyses that we're doing, you see permanent variable rate debt instruments that should lower the cost to the county. But the third one is one where we're doing a lot of analyses, talking with various financial institutions to see if they have interest. We are getting some interest from those where what we ultimately need to do, and we just kind of go, let's just jump at the moment down to page 12. What we need to do is extremely, extremely important. By April 2015, we have to make some very serious and hard decisions with this bond issue and have them implemented. Because this last extension that we just did expires in April. The cost has gone up again. I believe now for the 2015 budget, we're assuming that cost, that fee to the banks, again, remembering before it was 25 basis points per year. Then now it's going to be for 2015 budgeted at 320 basis points. So it's even another substantial increase. That expires April of 2015. At that point, we cannot do any more with the banks. We're done doing kind of these Band-Aids. We can't really wait for any additional financials to come out, whether a new audit or new budget or whatever the case may be. So what we're proposing here in December, I know you have a lot of other stuff going on with the budget, but I think we need to have some other meetings, whether they're committee meetings, whether they're board of the whole, to discuss in a lot of detail the options related to some of these longer term options that are related to this bond issue. Then in early January, we here in this room need to select an option of what to pursue, then actually execute that option sometime late January, early February, and then close on it in, say, late February, early March, ahead of that April deadline. That will be key. It's going to be kind of a big decision on what to do. We're going to be coming back with a lot of analyses, a lot of numbers for you. But the good news is because of the overall interest rate environment, we think we can get this done at a pretty attractive level and get the costs down for the county. No guarantee. We have some interest rate risk until that time. We have obviously a lot of bank risk. That those that may seem to be interested may ultimately, when it comes time to put pen to paper, may back out. But we're now at the point that we just can't wait for the next audit, can't wait for the next budget. We have to absolutely do something. So, the biggest takeaway for tonight is page 12. And we'll work.
The net effective interest rate right now exceeds 7%.
That's right.
It's 4% on the fixed, plus 3.2 on the bank fees. So
It's even a little higher than that. It's north of 7.5% because the bonds themselves are not even trading where they should be as well. So you're north of 7.5% on an $88 million transaction.
And there are a lot of people that might like to get 6% or 5% or 4% for their money out there.
Right. And so it may involve, the discussion will also involve whether or not you decide to go forward is terminating, there's basically two interest rate swaps related to this transaction. The one key option will probably involve terminating one of the swaps. And that will come at a cost. It's a pretty substantial price tag. However, to pay for that, the county will be financing basically that payment. And so it's going to minimize the burden. But the long-term impact, I think you're going to find a little bit more appealing than the current situation. So again, I think the big takeaway for tonight is overall your debt basically is performing as expected, except for the 2006 A issue. The county has not put on additional debt basically for the past 4 or 5 years. That's great news. Most of the debt is traditional fixed rate debt. It's not changing. If the county was able at some point in time to get an investment grade credit rating, single A, double A, whatever the case may be, we could be looking at refinancing, just going from a higher rate to a lower rate and achieving some savings with a fair amount of the county's debt. But the 2006 A bond, that's the one that's really causing the budget issue related to the debt. And that's the one we really need to focus on and get a solution and get a consensus here with majority vote to move forward with an option.
So again, clearly the recommendation that council needs to get together with this. We have a meeting on the 8th, that's in Hazleton. It's a public hearing. I think that we could also throw this on after the public hearing and have a discussion on that then.
For December 8th,
December 8th.
I'll have to check my calendar. Or how frequently are you meeting in December?
Look, can I just, this is millions of dollars of decision making. If we need 2 or 3 meetings, let's be really clear, this is millions.
Absolutely.
I don't care.
Oh, yeah, we're not gonna-
I'm trying to
No, I
get
want to
this
be,
started.
schedules, whatever we gotta do. This
Right.
is millions for the
Well,
next years, and we will be the most irresponsible board if we
Right,
don't
we'll,
get
we'll make it happen. I'm just trying to, obviously, I think that's the first meeting. Well, we could actually meet earlier if we wanted to, but I agree with you, especially with yeah, okay, so, you know what, listen, here's what. Okay. I don't want to get bogged down now with dates. You have our commitment to meet, and we will set up as many meetings as necessary, like Mr. Wilson said. So I don't want to get bogged down now with dates. We will do that. We will coordinate it with, coordinate with council as well, so we'll do that. So.
That'd be great. No, we appreciate that. And I think one thing that will definitely help, because of the magnitude of this bond issue and the dollar amount, and the impact of the county going forward and the taxpayers, I think one thing that will resonate sort of very loudly with the banking community, the investor world, is adopting a very sound 2015 budget. And that is going to be key, that they see. They're going to say, okay, we've seen now the 12 audit, we've seen the 13 audit, not looking that great. In 2014, we'll have to give them some kind of updated numbers, but they're going to be looking very, very closely with a fine-tooth comb at the 2015 budget to make sure that is kind of financially sound, not relying on the one-timers, and to just get a fiscally sound budget. I think that, you got a lot on your plate here over the next couple of weeks to pass a budget, but I think given that we're about to go into negotiations with a very large contract, if we go $88 million contract, this is going to be a very crucial time to make sure there's a very sound budget going into the new year.
So that's a small steps backwards, and it's a big step forward.
Can I just ask a question? We have the, you gave us the, I guess they're the initial amounts of the bonds. And
Those are the ones
initial-
outstanding right now, and the amounts outstanding.
Those are the amounts outstanding right now, so
Correct.
those are not what were issued originally. So this is the current principal?
Yeah, if you go to page 3,
Right.
the one pie chart, that's current amount.
Okay, all right, that was my question. So this is about a third of our outstanding principal? 88
Yeah.
million, right, yeah,
Correct.
okay. Okay.
I have one question. When you say a structurally sound or fiscally sound budget, what do the banks look for in that? The creditors or whoever would be monitoring that. What kind of detail are they looking for? You say one-time fixes, okay, we understand.
Yeah, they don't like the one-time fixes. They want to see that you can pay your pension on time, in the year that it's due.
In the year that it's due.
In the year that's due. I mean, they basically want to see more revenues than expenses. I mean, that's bottom line. I mean, to really cut down the chase, they don't want to see the one-time revenue sources.
So basically what you're saying, if I'm correct, and correct me if I'm incorrect, then obviously, they want to see us pay our bills in the year that they're due and not carry them over and use a TAN or use revenue the following year.
That's correct.
Thank you.
You're welcome.
Steve, one clarification on page 7. Ms. House mentioned borrowing. There was a significant reduction in county expenditures in, I think, 2008, 2009, 2010, from about 141 million down to about 123 million.
There were some large, yes,
A
that's right.
large reduction in expenditures of the county.
That is true. Yeah.
Just to be really clear, we did try to refinance in 2011, didn't we? We tried to do the credit rating, 2011, that didn't work, did it?
Correct. That was 2011. That's right. We made the pitch, and we didn't like where the outcome was going, so we pulled it.
I mean, it's nice to know we came down from a higher bloated status to being less bloated, but nonetheless, we still didn't get it in 2011. And to be really clear, 25 basis points that we have now, and that's wonderful. We know we're not going to get this. The high hope is we basically get something better than 3.2 or 325 basis points. That's our goal here. We know we're going to lose, but we want something a little bit better.
Sure.
That's it.
Sure. Now, the one big thing that we're going to you know, once sort of the kind of the rest of the finance team is kind of picked as far as the underwriting team, whether it's one firm or multiple firms, because it's a large issue, we need to think about either selling this new issue as non-rated. You know, what do we think we can get investment grade or not? The reason that we're thinking about selling a non-rated is because of the very low interest rate environment we're in. Even non-rated transactions are still, if structured correctly and have the right team in place, can still get, you know, fairly decent interest rates. We also need to think hard once we get the rest of the team formed, again, which is basically just underwriting component, whether or not we do want to try to go back to Standard & Poor's or Moody's, test the waters again a little bit. At the moment, I'm a little hesitant on doing that, but after I think we see how this budget comes, how the budget comes to fruition for 2015, we may want to have some folks take the trip back up to New York, maybe invite them down and talk to them and see if potentially we can get kind of the lowest tier in the investment grade rating. It may work, it may not work. And that's, you know, basically here on page 9. We would shoot for whether or not, again, we go to Moody's, which is up top, or whether we go to S&P, which is on the bottom. We would shoot to be in that lowest category of the investment grade. We may even possibly want to try to get, you know, we might even go to them even if we would get a very high non-investment grade rate. So there's just a lot of stuff happening in the market that we need to really focus on this here for the next couple months to get you ultimately the best deal.
I personally think, and I think it's a fair, reasonable goal for this county to shoot for that in 2015. And then we're going from 2011 to 2015. I think we have made some, I mean, we're clearly not where we need to be, but I do think we've made some strides.
And they should not go unnoticed. They need to be presented to the
I don't feel that holding off and not going is going to help us. And again, we might not be shooting for the stars. We got to make this from both ways, so we got to shoot for something. So I think that's a reasonable goal for us.
Just if I could just answer Mr. Morelli so about the question of when you go to the credit rating agencies, there is no time limit. You go when you think you look as good as you possibly can be. Is that fair to say?
You typically try to go when you think you look the best.
Right before you got to refinance like this, basically.
Right.
Before you get a big one.
We would go, even if you were looking very good and you didn't have anything to do, we would still want to go to them and say, hey, there's no issue, there's no bond issue that the county wants to do, but we feel the county's ready now for a credit rating. That's one time to go. That's the most probably opportune time. We're now at a point where we have to do a transaction by basically April of 2015. We may really try to force the issue with them and say, hey, look, we're not where we need to be. We understand that, but we have made some progress, you know, over the past 3 years, 5 years, you know, whatever time period we want to do. We understand we have more to do. You know, we've survived through the home rule change. That's working out. We just adopted a 2015 budget, very sound budget, and we're kind of learning from some issues that have been done in the past, and kind of see what happens with that, Chris. So we're going to be sort of in that bucket where we have to do something. Now it's whether or not we go to them or we just try to do it unrated.
And not to belabor, Scott, just to be fun, not need to be funny about this. We do have some advantages. Our advantages is that one, there is a current appetite for these type of investments. I mean, there is an appetite for this type of bond out there. People want it. We're lucky to have that. Is it fair to say the 88 million is actually sizable enough that that will also bring people to the table?
Yes and no. Because it's 88 million, we may need to, because it's 88 million with a, again, I'll use the word loosely, a distressed credit. That's where we may need to have maybe 2 underwriting firms, maybe even 3 underwriting firms. One firm may not want the full exposure to it. They might want to share some of the risk. There's no additional cost to the county to have 2 firms or 3 firms. It's just their slice of their commission is spread between them. But I think it will give them more comfort that they're not in it alone.
Thank you.
Anything else for Scott?
So we'll work with the administration on some dates, and again, everyone acknowledges it's very important, so we'll try to get a schedule laid out when we can.
On this, we'll start tomorrow, and we'll get on it. We'll make sure that happens.
Excellent.
Okay? Thank you, Scott. Appreciate it. All right.